It's the artificial intelligence revolution, and you discover that you have 24 redundant data centers that are hooked up both to the fiber optic cable network and the power grid.
Even though the average price per bit is coming down, the amount of bits that goes through Cogent's pipes has been increasing, and it's only going to increase more and more.
So Cogent believed that they could turn this thing profitable, acquiring it for $1, before there was going to be this huge increase in internet traffic from AI.
Hello and welcome to the Margin of Sanity podcast. Today we're talking about a company you probably haven't heard of. The stock trades on the NASDAQ under the ticker symbol CCOI. The company is called Cogent Communications, not to be confused with Cogent Biosciences, which is a completely different company. To explain this thesis, I have two guests here. One is my good friend AK from the Unfair Advantage Substack. You may remember him from our conversation about the company Caspi. And the other guest is a new friend of the show. You'll know him by his call sign on Substack, Unemployed Degen. Cogent may seem boring to a layman, but it's a fascinating company for folks like us. The stock has fallen about 70% off its highs at the time of recording this to a share price of about $22 a share. The company has been around since 2002. It IPO'd immediately following the dot-com crash. And soon enough, you'll understand how the ashes of the fiber optic boom and bust gave rise to the phoenix known as David Schaefer, CEO and founder of Cogent. It's a fascinating case, and my mouth was watering by the end. AK and Unemployed Degen collaborated on Substack about this very company, so I encourage anyone listening to go check out that write-up. Both these guys have all sorts of really great stuff that I really enjoy. I'll post links to everything in the show notes. And if you like the show, don't forget to share it, drop a like, comment, or 5-star review. It's very much appreciated. And just a reminder, we are not financial advisors. None of this is a solicitation to buy or sell any securities. Always consult with an advisor. Investing always involves risk. So yeah, be careful. And with that, please help me welcome to the Margin of Sanity podcast, AK from the Unfair Advantage Substack and Unemployed Degen. All right, AK and Unemployed Degen, which is like one of my favorite names I've ever heard on Substack. Thank you guys for coming on and talking to me today about Cogent Communications.
Well, thank you. It's a pleasure.
Happy to be here.
All right. So I think we can kind of get straight into it and also just see where we go. But AK, you pointed this out to me the other day. You shot me a message about Cogent, and I thought you were talking about the pharmaceutical company. And I was like, I don't really invest in pharmaceuticals. And you're like, no, Cogent Communications. And so I started to take a look, and it seemed like a really interesting company. It reminded me of our shared AMR bet, where you have a lot of interesting sort of unique assets and a business on top, and sort of there were a lot of reasons the market was sour on it at the moment. But maybe you guys can just tell me a little bit about how you came upon this, how you ended up working together on it, and just generally give me a general lay of the land of Cogent so I can kind of get my head around the thesis.
Yeah, I got the idea from AK, so blame him. It's all his fault.
Okay.
But yeah, AK, how did you find it in the first place?
So this is a fun story. I was going through SumZero's video pitches. SumZero had some YouTube pitches of all the hedge funds, and honestly, most of them were something I couldn't even get my arms around. And then there was one hedge fund, I'm not able to remember their name, and they had pitched Cogent. And even then, I wasn't very impressed with it. I had discarded it. I think I just left it for a few weeks till I came upon a podcast of the Cogent Communications CEO, David Schaefer. So this podcast is called The Bear Roars, and it's a podcast by this guy called Dan Caruso, who was the founder of Zayo Holdings, which was another Cogent type company. And he was interviewing Dave Schaefer. And within 15 minutes of listening to that podcast, one thing was very clear, that Dave Schaefer is a very, very smart guy. And we can get into his story in a bit, but that's when I started taking a look again at Cogent. And the first thing, of course, when you search for Cogent Communications recent news or investor press releases, the first thing that comes up is their $1 acquisition. And that's how I came upon the Cogent, and I started digging deep. It was like looking into the CEO, looking into their acquisition, and then looking into their core business. And that's when I reached out to Unemployed Value Degen saying, hey, this stock seems very interesting. It's got all the anomalies you'll expect. You have a fantastic CEO, you have a strong core business, and there is a sort of an optionality on top of it.
Right. So you guys are going to have to explain, I think, the business itself. It's one of those things that I feel like is just boring enough and just technical enough to put off a lot of people, which I think is good. At a glance, at looking at the business, if you sort of just excluded a few factors, I might be a lot less interested in this. So maybe we can just talk pre-2023 acquisition.
So what Cogent does, it's very tied into who the founder is, and it's very tied into this acquisition. And it's also really helpful because we're looking at this data center build out and saying, okay, it's going to be the next bubble. How bad is it going to get and what's going to happen? Cogent Communications' founder, Dave Schaefer, saw in the early 2000s that there was this huge overbuild of laid fiber optic cable. And it's kind of that old story that, the third owner of a building makes money. He saw that he could acquire this stuff so cheaply. I think before this most recent acquisition, they had done 7 acquisitions, I think for a grand total of $60 million. And they had acquired something like $15 billion of build cost fiber optic cable, because the dot-com bust was about laying all this fiber optic cable that, was a huge excess capacity and everyone involved went bankrupt. But it has so little maintenance capex. Once the fiber optic cable is laid, it's this huge, huge benefit to industrial capacity, but it's not fetching rents anywhere near its build cost, right? The rents that it's fetching are low because it's massive overglut and overbuilding, which was a very US-centric problem. It's not the case that the rest of the world overbuilt fiber optic cable, which is important because now Cogent, buying all this fiber optic cable, their margins are triple outside of the US than it is inside the US. So Dave Schaefer did all these acquisitions and became the owner of an infrastructure asset that he now has a company that handles 25% of internet traffic. So Dave Schaefer bought all this laid fiber optic cable. He's got 25% of the internet traffic on his infrastructure, which is mind-boggling for how little all those acquisitions cost him. So, leading up to the big one that was recent, there was another 7 acquisitions before that, and it was all coming in the early 2000s saying, okay, you guys are all bankrupt. You've built all this fiber. You can't make any money. And his whole idea was, I'm going to buy this stuff for nothing, and I'm going to be the most efficient operator in the space. And so by charging half of what his competitors charged, he took enormous market share. That's kind of the business model, is you acquire it for nothing. You offer really good service. So where his competitors were taking 3 or 4 months to connect buildings to their network, he would do it in 30 days. So you have better service, half the price, and now be responsible for 25% of internet traffic, which is just amazing. So that's what Cogent is. It's acquiring all the laid fiber optic cable that everybody else overbuilt in the dot-com bust, and leading up to this giant culmination of this most recent acquisition, which was at a $20 billion cost. Sprint created this enormous fiber optic cable network, which then got acquired by T-Mobile, and then Cogent acquired it for $1. $20 billion build cost in the 1990s. I don't even think that's inflation adjusted. Now it's acquired for $1, but it came with all these legacy contracts. I mean, T-Mobile was losing money on the thing. So you really needed an efficient operator to come in and make it profitable. And we're now going through, I think, 9 sequential quarters of digesting this $1 acquisition. And it's working. Now, it's slower than I think some people would have liked, but it's 9 quarters of sequential improvement of now digesting this enormous acquisition. Another thing to point out is this deal with T-Mobile to acquire the Sprint network, that was started before the AI revolution took off. So Cogent believed that they could turn this thing profitable, acquiring it for $1, before there was going to be this huge increase in internet traffic from AI. Because we're coming off of the streaming expansion. Internet traffic was growing 20% a year because of streaming TV shows and all that. That had slowed down to about internet traffic growing about 7% a year. And now things are just starting to pick up because of AI. So now you have this huge infrastructure, this massive laid fiber optic cable network, and data traffic's about to grow again, which is just an absolutely fantastic position to be in. It's very, very fortuitous.
Yeah. There's a lot of tailwinds that you were just talking about that make someone like me think there's a good future. But before we get to that, maybe we could just talk a little bit about the difference between maybe a company like Cogent and, T-Mobile, Verizon, AT&T. This isn't a business that sells bundles. They don't sell to residential homes, or there's no cable or TV. This is just fiber optic, and it's for office buildings, right? Data centers, a lot of law firms, financial services businesses, things like this. So maybe you could just explain to listeners like what's different about Cogent than pretty much anybody else in this space.
I'm happy to take that. So Cogent's main business, like we pointed out before, is that they help connect data centers and any internet access provider. So they are basically an internet access providers. And one of the reasons we haven't heard, instead we hear about Virgin or Sprint, is because they mainly cater to businesses. So one part of their business is what is called as on-net, or what they call as on-net business, where they own the network till the last mile. So all the way till the Ethernet port in the building, they own it. So they have about 1,600 to 1,700 buildings across US where they own the internet connectivity all the way to the last mile. And that comes with a couple of advantages, right? So one is they don't have to pay any other network provider any fees or any leases for accessing their network. Second is, like we pointed out, they'll be able to provision this connection much faster than their competitors, and they'll be able to price it much lower. So that's kind of what started setting Cogent apart. When the competitors they had a sort of a scope and a scale issue. They wanted to be big and they wanted to do everything. So they were doing voice, they were doing data, they were doing multiple internet protocols, and Cogent just focused on one thing. So they bought up all these fiber network assets, and all they focused on was providing internet connectivity through Ethernet. And that was all they did. So it was a very narrow product set. They only used Cisco routers. So unlike their competitors, they didn't change the vendor either. They just went with Cisco equipments, which meant that whenever there was an issue, they could just rectify that much faster than anybody else. Their second business is what they call as their net-centric or the data center business. This is where they help move vast amount of data from data centers to other data centers, and their customers are typically either the content providers or online streaming companies who have requirements which require to move huge amounts of data. So they price this on a per megabit basis, and these companies buy this bandwidth, and as their bandwidth needs grow, Cogent basically increases their revenue because they're priced on a per megabit basis. And their third business is what we'll be talking about at a later point, which is their wavelength business, and that comes from their Sprint acquisition. And that is where sort of most everybody's eyes are on, because that's really the optionality, and that would probably ride the AI wave as well. But their core businesses, which is a huge sticky business, which is the on-net business, and then you have the net-centric data center business. They also have a smaller part of the business, which is called off-net, and that's where they don't own the last mile. But that is a lower margin business, and I doubt they're really spending a lot of time focusing on it.
Right.
Their biggest focuses are on the on-net and the net-centric.
Got you. So it sounds like, to use a metaphor, I guess, Cogent is sort of if you imagine a bunch of train companies, Cogent sort of acquired a bunch of defunct railroads specifically for B2B. It's not consumer rail. It's, bringing coal or oil to port, and the most profitable way they do this is when they control the entire rail line that goes from the provider to the consumer. And they occasionally engage in this off-net business where somebody else owns the last mile of delivery of that data, right? Is that like a fair way to oversimplify it?
Yeah, and what really scared the market is this T-Mobile acquisition came with this enormous amount of off-network business, which Cogent didn't want. They went through and they were actively firing their customers. So now you have the problem where you have declining revenue. And also there was a certain amount of CapEx associated with digesting this acquisition and rationalizing it for the network. So you have this sort of 10-quarter period, 9-quarter period where they spend money on CapEx. The revenue has this massive spike, but now you're in this period where every quarter revenue is falling. But while revenues are falling, EBITDA and margins were increasing because they were intentionally going through and firing customers that they didn't want. And this, the Sprint network, they were active in countries where Cogent isn't even active in. So they had to fire a lot of sub-Saharan Africa customers. They had to fire a lot of Central Asian customers. I think Cogent just expanded their 58th country, which is India, which is an enormous market. And as AI picks up and their margins are so much better outside of the US, if all the AI data processing and data centers is happening in the US, all that traffic internationally from foreign customers using AI is going to pick up a lot of volume where their margins are triple, where the US margins are.
Got you. And so this is a pretty international business then, I guess.
Well, if you go back in ancient history, the US was sort of the ground zero for the internet, and it used to be 80% US, 20% international. And now the international share has grown, so it's very close to 50-50 now, domestic versus international, because just everybody's connecting to the internet. We've got a lot of poor countries out there where people finally, I saw this when I lived in the Philippines for a couple of years. If people have a little bit of extra pocket money, the first thing they do is they buy a load for their phone, and they want that data, they want that access to the internet.
Yeah, it makes perfect sense. When you have a sort of unique asset like this, which is a network, right, of fiber optic cable, there's a lot to be gained from just like even marginal improvements in per capita GDP across the world, which, we've seen over the last 5, 10, 20, 30 years as a pretty general structural shift upwards. So I like that they have so much exposure to international markets in this, what appears to me to be a very stable sort of business. And, I guess maybe you guys could kind of fill me in a little bit about why is fiber optic data transfer going to be around and equally as important in, 5 or 10 years as it is today? I mean, is it just like they've already sort of laid the lines and you couldn't lay another line? It would have to be, the only competitor would be something like SpaceX or Kuiper or something like that. I don't know that much about what advantages fiber optic offers.
What's interesting about that is, so there's a lot of people who like that American Tower REIT, which is trading at a price to earnings of 30. But we're already seeing, Starlink is going to come in and compete over cell phone service. We're probably not that many years away from using satellites for phones and cell phone towers being a thing of the past. But when you're dealing with the sunk cost of laid fiber, you're moving at the speed of light, and you're also moving directly to the target. So if Starlink tries to compete with laid fiber for data, you have to send that data transmission into outer space and back to the Earth again. So your triangle now is longer than just going through the laid fiber optic cable network. And you also have packet loss due to weather. So this is an instance where the superior technology is this massive sunk infrastructure that Cogent bought for $1. And the satellite network probably isn't going to be an effective competitor to them for a good long while, or maybe ever. Maybe in the future, if capacity needed to increase and we looked at the cost of laying a new fiber optic network, maybe satellites would compete with that. But you still have the packet loss problem from weather. And this is another thing which made the Sprint acquisition so amazing, which I just learned the other day. So when you're talking about laid fiber, a lot of it is done, in plastic conduits at a shallow depth. And so then the next time some heavy machinery is moving through and they didn't look for all these laid cables, the cables get severed when somebody's doing construction in the area. And then you have downtime. What's so amazing about the Sprint network and why it cost $20 billion in the 1990s is they laid it in armored cables at depth underneath railroads. It's almost a perfect parallel to the railroads because they're literally underneath the railroads. And so this is now, moving at the speed of light and probably not going to get cut. They have much less downtime, much less service interruption than their competitors because it's not shallow and in a plastic tube. And you look at some of the data center demand now, some of these data centers, they have really, zero failure tolerant systems. You don't want to have, just like the Apple subcontractors, if you fail to deliver on time, there's these huge penalties. If they're going to spend all these billions of dollars, hundreds of billions building out a data center, they don't want downtime because somebody with a backhoe cut through the cable. So I think
Right.
it's not even a commoditized product. Cogent has the best thing now. So if you're Meta or you're Google and you want an uninterrupted data stream, I think Cogent has a pretty interesting value proposition there to have armored conduit fiber optic cable that's buried at depth underneath the rail lines.
Right. It does seem like they're sort of the lowest cost producer of this service. And it wouldn't be as low cost, I guess, if this was the original company having to make back enough money to justify the capex they spent to lay the cables in the first place. But because Cogent was able to acquire all of this fiber for, pennies on the dollar, and now Sprint, they've acquired $20 billion worth of cable for $1, it's sort of just a matter of time. And I can't even imagine how somebody would compete. Who would they consider competition?
Their big competitors are AT&T and Lumen, who both paid the cost to build their own networks, and they have the debt on their balance sheets from building out their own network. So again, this is, the people they're competing against do have a harder time discounting and competing on price because they had to pay to build out their own networks. And so as a competitor, it's like the worst thing you would ever want to see arrive is somebody who bought a capacity that's better than yours for $1.
Yeah.
It's really a nightmare for places like AT&T and Lumen. And Lumen trades at, a pretty high multiples, and Lumen's a bit of a darling.
Interesting. I don't know that much about Lumen. I know a decent amount about AT&T, and if AT&T is our competitor, then that's fine by me.
I don't know if one of the other things, maybe I should have written it more detail in the Substack, is Cogent has these kind of ring architectures. To Stephen's point, so they've built out these rings around every metro city in US. And what happens with that is if their network was to be severed at any point, they could simply reroute the signal in the anti-clockwise direction. So even if Cogent's network gets severed at any point, it's a ring architecture. So instead of the data going clockwise, they could just reroute it anti-clockwise and still make sure that there is no downtime in the network while they repair the severance.
Interesting. That's it. That's a really interesting point.
Yeah. And that structure cannot be rebuilt again. Once it's set in stone, it's done. And they have that right now with them. So if customers like Google and Meta want 100% or like near 100% uptime connections, Cogent is a very good company that can provide that because of multiple things. One is their simplified network architecture and their ring architecture. So that puts them in a good position to capitalize on these.
There's another company I follow, Applied Optoelectronics. They make the transceivers that connect the fiber optic cable to transmit light information back into electric impulses so the computer can understand it. And they'd already talk about some of these data centers are so zero tolerance. This is hardware that's expected to burn out after 5 to 7 years. And the zero tolerance data centers, they preemptively replace them at 3 years. Because again, you don't want to have your multi-$100 billion data center have downtime because of a $5 part. And the same is going to be true for the data connection. So being the high quality provider, being the less interrupted service provider, being the one that has the laid fiber optic cable in armored conduits under the rail lines, it's not going to get severed and has, this redundant ring architecture. It's a huge value proposition. And then on top of that, they price cheaper than their competitors. The founder, Dave Schaefer, kind of takes it as a given that he's going to take market share because for 20 years they've been doing it and they've been taking market share. I mean, you sort of get your customers one at a time, and they've been doing it. They've been growing their sales team and been effective at getting customers for 20 years because the value proposition is a no-brainer. We're better and cheaper.
Yeah. I guess if you're acquiring all the cable and all the networks for, a ridiculous discount, you don't have to earn such high returns on such low capital, while AT&T has to charge a certain amount or else, they can't pay their debt or shareholders revolt. So yeah, I would imagine it actually is pretty easy for them to take market share. It almost reminds me a little bit of Warrior Met Coal, where they're providing sort of the highest quality thing and they're doing it for a cheaper cost than anyone else. And it's sort of hard to argue with that, even in a business that you could consider I don't want to say it's a commodity because it's the means by which you provide it isn't so fungible, but data transfer is data transfer, all else being equal. So it makes a lot of sense that their market position in and of itself is their competitive advantage. So just so I have this right, so, we have this incredible network of fiber cable. We have like roughly a 50-50 split between the US and international over time. They've been gaining market share over the last, decade and a half, 2 decades. And then they make this big acquisition. The acquisition, I like that you use the word digest because I'm sort of imagining a snake eating like a giant rabbit with the big, kind of, if you imagine like the rabbit-sized lump in its stomach. But it's sort of I guess part of the theory would be that it's a matter of time before this is digested and before they can transition from the low margin off-net business to the on-net business. So maybe you guys can just help me understand a little bit about how they're making that transition, how they are taking this sort of cash burning machine that they bought for $1 and turning it into something that's worth something.
So the acquisition in itself is very interesting. So for T-Mobile, from what I heard from the interviews, T-Mobile tried to sell this asset twice and they couldn't get anybody to do it. They couldn't get anybody to buy this asset and they gave up after that and decided to do it themselves. They said, we will turn around this thing ourselves. They got a bunch of management consultants and they couldn't turn it around. And then they put it up for sale again. And I would say Cogent got a really sweet deal. So the deal terms were as follows. Cogent was to get the 19,000 miles of long-haul fiber from T-Mobile. Mm-hmm. They would get a fixed wireline business, which is the cash-burning machine that they had to take in. And on top of that, T-Mobile was to pay them $700 million in IP transit payments for over a period of 5 years post the acquisition. Mm-hmm. And on top of that, T-Mobile also promised to put in about $500 million in CapEx before the acquisition into the same network. And it was on those terms that Cogent acquired that for $1. And what they acquired, the fixed wireline business was burning around about $300 million a year. And this was a situation in which Cogent acquired the T-Mobile, the Sprint fiber. And this is when sort of things started to really get interesting.
Yeah, and also the digestion period, I mean, there's still more to go, but for the most part, the wood is already chopped. They've guided toward this upcoming quarter to be their first quarter returning to growth. So the period of them firing all their losing customers, I mean, there's still going to be a few. I think they predicted like a 2% annual decline in that business. But their core business is going to be growing at 6 to 8% a year. And it's not that common that management teams guide to the exact quarter of inflection, but they guided that the next quarter is the quarter where they return to revenue growth, which is just an amazing timing perspective to see the stock price crash so hard on a world where the work is already done, right? The medicine's been taken, the patient's recovering, and the stock price is now scraping the bottom of the barrel. And the story of how the stock price got crushed so hard, I think, is important because Dave Schaefer, the founder of this business, the guy is a genius. He graduated with his PhD when he was 17 years old. He then built out his father's taxi company to take half of the market share in the DC metro area. And it was kind of his idea in the early 2000s to say, wait a minute, I could buy all this fiber optic cable so cheaply. But he had taken his own personal wealth and he had bought something like 50 Class B office towers in the Washington, D.C. area. And he had pledged his Cogent shares as collateral, as cross collateral for some of those loans. And then between COVID and then now Trump laying off a bunch of federal contractors, he got margin called. And so the founder's ownership in Cogent went from like 10% to 1%. That cut the stock price in half from 80 to 40. And then after that, so they had been paying a very strong dividend. They had had something like 52 quarters of a growing dividend. And they had even levered up to pay and increase the dividend, which, some people look poorly on. But if you have a steady state business, you do want optimal capital allocation. You do want optimal leverage. And so they had levered up to keep growing the dividend. And with a 3-year digestion period for this acquisition, they finally cut the dividend. So the dividend was suspended. And that cut the stock price from 40 to 20. Because when you cut a dividend, you're immediately booted out of all the ETFs and there's all this forced selling. So this is a world where you have these two idiosyncratic events that take what is a very stable business and convince the market that is not a stable business and get a massive penalty. But as EBITDA continues to grow, as revenue continues to grow, as it inflects, it's going to take some time to convince the market again that this is infrastructure. This is a very stable, very boring infrastructure business that should trade back up to, stable infrastructure multiples because it just hasn't behaved like a stable, boring business because of those very idiosyncratic events. Not to put my neck out too far, but I feel like the worst is over. I feel like the next idiosyncratic events are going to be positive things, the return to revenue growth, increasing margins. And also, when they cut the dividend, they had a share buyback program. They had been leaning more heavily on dividends than share buybacks, but now they're paying down some of the debt that they had taken out to pay the dividend to get to their capital allocations. Not really optimal. They don't have optimal debt anymore after, spending a couple years digesting this acquisition. They want to bring the debt level down. They want to pay down some debt, but they do have 106 million authorized on a share buyback program. They're not going to authorize any new share buybacks until their debt is 4 times EBITDA. It's currently 6 times EBITDA. But with the stock price so low, they did kind of leave it a little bit sneaky. They might actually burn through that $106 million share buyback authorization while the stock price is so low. And that might even explain the stock price strength the last week, because they might actually be in the market buying these shares now. We don't know, but we know they're not going to authorize any new share buybacks until their debt's 4 times EBITDA. But they did say that they would be willing to spend that 106 million, which on a 1.13 billion market cap company is, that could be why the stock price went from $18 back up to 22 in 2 weeks.
Yeah. It makes a lot of sense. And you were talking before about the wavelength business. And I'm kind of curious how related that is to the acquisition. It seems like it's directly related because I don't see any revenue from wavelength until 2023. So, I guess we can expect the revenue from the corporate off-net business to just continue to decline as they kick out customers and stuff like that. But overall revenue should be increasing. And I think, AK, you were saying something before about the wavelength business. And maybe you can explain what that means to me, to a Luddite like me.
Yeah. So the wavelength business is what they call as a fixed wavelength business. It's on economical terms, it's very similar to an on-net business. So the revenue they make is based on a price per megabit multiplied by the megabits that they can transmit. So think of it like a pipe, the more amount of fluid that goes through it, the more money that Cogent makes out of this. And they have customers across technology space, the Fortune 500, and say the SMB market as well, the small and medium business. And across all this, they're kicking out the ones which are unprofitable and retaining the customers that are profitable, or increasing prices on the remaining customers. And they have guided to around adding 400 to 500 connections of wavelength businesses, or wavelength connections every quarter. And every connection gives them roughly about $2,000 in annual revenue. And right now, one of the things that the market has not been super happy with is that the pace at which this wavelength business is growing. Although it's gone up, I think they've added like about 140 connections from Q2 of last year, Q2 25 from Q1 25, and then they increased that to about 280 connections. Dave Schaefer also mentioned on the call that there were about another 300 odd connections that they have sold, but it hasn't started generating revenue yet. And so those would also kick in. So if you see the math, about 280 connections which started generating revenue, another about 300 that is yet to start. So they are roughly on track to do those 500 connections a quarter, which feels like the management is doing what they have promised. They are able to kick out the unprofitable customers. They are able to grow the wavelength business. But I think there is some level of impatience to get this business up and ready, like right away. But like to Stephen's point, we think the worst is over. And perhaps from the next quarter, we're going to see some level of inflection.
Right. And so going forward after the digestion of this, are you thinking of this as sort of a re-rating story, or just like a moment to buy a great company at a fair price or even a cheap price? So let's say this all happens as you're saying, there is this inflection that management is guided for next quarter, and, sort of operating income comes back and there's a return to, I don't know, maybe high single-digit revenue growth over the next few years. Is there more to the story beyond that? Is there sort of a expanding margin sort of a thing? Is it just this continued acquisition of cheap fiber assets, continuing to expand into new markets? Like, how do you see the story looking past 26, 27, 28 into the 2030s? What does this business look like?
Yeah, there's a very different set of near-term catalysts versus long-term potential. So it's very hard to put a price target on, or even a strategy. So like, oh, I'll sell out in 2028 when they're back to peak multiples or something like that. In the near term, you have this inflection back to revenue growth. You have this improving EBITDA situation as they keep on improving margins, as they keep on firing bad customers, as they keep on growing their legacy business. There's one other near-term catalyst, which I think could cause a big re-rating. And that is, and this was also, again, not part of the original reason why they acquired the Sprint network. This is in response to the AI revolution, which happened after they had agreed to buy Sprint, is that this data center network, it comes with these office buildings at critical points for processing data. So they are data centers, but they're sort of older, smaller, low-spec data centers. This isn't going to be what Google would want to put a bunch of, or not Google, but Meta is not going to put a bunch of Blackwell chips in there because it doesn't have the ceiling height for the right cooling towers and all that stuff. But they are data centers. And before the acquisition, Cogent had, I think, 53 data centers that they use to process the data that comes through in the fiber optic networks. But the business model is you kind of overbuild. It's larger than you need. And then you sort of lease out the remaining square footage in your data center. And they had something like 53. They acquired, through the Sprint acquisition, another 44. So now it's a company that has 97, 98 data centers. And they found 24 of them were redundant. So now it's the artificial intelligence revolution, and you discover that you have 24 redundant data centers that are hooked up both to the fiber optic cable network and the power grid. So this is not a situation where you have to go to the local government and get a permit and go to the utility and say, please, sir, can I have some power? They have 100 megawatts of data centers already built out, already with electricity, already on the fiber network, that they can now just sell into the artificial intelligence revolution. So they identified 24 data centers they could sell, and they immediately, it cost them another 100 million in capex to modernize them. But they immediately got 6 letters of intent, and some of the letters of intent were to buy all 24, and they already agreed to sell the first 2.
Do we know the price that they sold them for?
Yeah, it was, I think, 140 million for 2, but they also hinted that those are 2 of the larger ones. They had guided toward this data center sale, bringing in somewhere in the neighborhood of $500 to $550 million. And again, this is for a $1.1 billion market cap company, and they're going to say, surprise, we found $550 million in change between the couch cushions. So that's a huge near-term catalyst. Now, there are some doomers and naysayers out there saying that these buildings are small and they're old and they might not sell some of them. But my counterpoint to that is this is the AI revolution, and this is data centers are the hottest commodity on the planet, and these are already hooked up to electricity. You don't have the utility able to say, no, we'd rather not supply you electricity. You have to build your own power gen. So to have a pre-existing built data center, and not everybody's trying to create artificial general intelligence. There are a lot of data center uses that can use, some older hardware. And we saw this recently with NVIDIA. So, NVIDIA's claim to fame is that they have the most cutting edge chips. But then to sort of bolster demand, they said, but hey, you guys should know our 6-year-old hardware is still being fully utilized. And that sort of had an opposite effect. It kind of hurt the share price because AMD and Broadcom might be 3 years behind NVIDIA. But if NVIDIA's 6-year-old chips are still working, AMD and Broadcom are not 3 years behind NVIDIA's 6-year-old chips. So they're sort of weak in their monopoly position, but applying that to Cogent Communications 24 data centers, there are chips out there. There are data center setups that'll work in those data centers. So I'm pretty confident that management guided toward about $500 million in sales from those 24 data centers. And management is extremely conservative. So if anything, I would expect them to do better than that. And again, they've already had non-binding letters of intent for all 24. So the idea that some of them aren't going to sell, they already have interest on all of them. So anyway, I think you'll see that money go to pay down debt, which alone would bring their debt to EBITDA below the threshold to do more return of capital to shareholders. And if the stock price stays low, then they're probably going to prioritize buybacks. Because one of the benefits of a dividend is if it's stable and if it's not cut, you build this shareholder base that values it. But implementing a new dividend, you don't get that benefit right away. It takes years and years and years. Whereas share buybacks, the float decreases immediately. So if they chop off $500 million of debt and focus on share buybacks in the near term, that's amazing. But in the longer term, having the whole world, wanting to have their data crunched through these US built out data centers, because Europe is not building that many data centers. There's too many regulations. Canada is doing a little better than Europe. But for the most part, if you have all this traffic that you want crunched, the data centers are getting built in the US. So the trans-international data communication, the internet volume, has a chance of really picking up significantly. And if you're already 25% of global internet traffic, and internet traffic goes from growing 7% a year to back to growing 20% a year, it's a huge, huge tailwind for your industry. And if we ever get to the point where, so Corning is the company that made all this fiber optic cable in the first place. And there was this amazing news article out earlier this year. They had stockpiled in warehouses enough fiber optic cable from the dot-com bust. Corning only went back to manufacturing fiber optic cable again this year, 25 years later. So that's how much surplus fiber optic cable had been built in the dot-com era. If we ever get to the point where the data traffic is so large that laid fiber is constrained, and that it actually fetches, something has to fetch a market rent in order to stimulate more new construction. So if that laid fiber ever becomes enough of a bottleneck that the prices have to justify new build out, then suddenly you would have Cogent earning a 6% yield on a $35 billion sunk infrastructure. Well, that's a lot higher than 6% of $35 billion is a lot higher than their current revenues. So if you ever get to the point because of AI that data traffic really would cause prices to actually build out new fiber optic cable again, Cogent would be this massive moonshot beneficiary of all that.
And, to think about it right now, we are clear that there's a very high probability that Cogent is going to come out with the other side, getting back to their historical free cash flow levels, and maybe even a bit more from the wavelength business. So even if we assume that it's sort of similar to the levels that they were at before, which it wouldn't be the case, that'd be about like $150 to say $180 million. And this free cash flow is going to grow because even though the average price per bit is coming down, the amount of bits that goes through Cogent's pipes has been increasing since the last 20 years, and it's only going to increase more and more. So this free cash flow about say, let's say $150 to $180 million is going to continue growing. And the entire company is right now in the market for like about $1 billion, which is roughly like I would say 12 to 15% free cash flow yield. And that cash flow yield is going to grow. And like we just discussed, it's an infrastructure asset. The customers are sticky. Likely there is no new fiber network going on the ground. So it's going to be whatever network we currently have, people are going to live with it. So there's a very high probability that this is initially a high free cash flow yield kind of a setup, and that's continuing to grow for a long time. And as far as they keep the capital allocation kind of rational, say mix between dividends and buybacks, this can be a reasonably good long-term hold simply because the initial valuation is low and the business is sort of rock solid.
Interesting. So I'm trying to come up with a good bear case here, which is, trust me, a huge compliment to the bull case. So what percentage of their customers are maybe people who own office tower real estate? Is it the office tower owners? Is it the businesses that are actually operating within the office towers? And how does that sort of business compare to the data center business and the Netflixes, Amazons, etc.?
So on a quarterly level, right, around 40 to 50% of their business is going to come from what we call as the net-centric customers. So these are the tech-heavy, internet-based businesses that have large data requirements. And some of them are even internet service providers themselves who use Cogent's network. And then you have the remaining about, say, 15 to 20% roughly, I would say, is these corporate customers. So corporate building owners who have the Cogent connectivity till the last mile. So Cogent works with these building companies. They build the riser, which means the Cogent network can come all the way to the Ethernet port. So if a tenant wants internet connection, it's going to be as easy as just sticking the Ethernet cable into the wall and they would have the internet connection. So those on-net customers are about 15% of the revenue. And the rest is off-net and about like a little bit of wavelength business as well. Wavelength is growing, but it's still a small business. So it's about like less than 5%. So right now, wavelength is less than 5% of their total revenue. But it's growing, but it's still small.
Gotcha. All right. So we have $1 billion market cap business which historically was earning, maybe 130, 150 free cash flow per year. Stop me if I get any of this wrong. I'm just off memory here. There's maybe a little over 2 billion in debt. There's maybe 140 or 50 million in cash. And there's a potential sale of these, as you put it, change under the couch cushion data centers that they could sell off for roughly 500 million potentially. And we're looking at return back to roughly 150 million in cash flow. So it's hard to not see this as an undervalued company.
Yeah, and one thing about the debt is not all of their long-term liabilities is debt. They do have some capital leases, some international connections, and things like that. There is some of their laid fiber network that's on capital leases. So the actual debt to pay down is a little better looking than that. So their balance sheet's, slightly healthier than you would think. And then previous back to what you were saying, I mean, the name might have gotten caught up a little bit with the whole, are we all going to work from home and is office towers never going to be a thing again? But I think what we're seeing in the market now is office towers, most companies are figuring out that to get creative productivity out of their employees, they have to be in the office, at least 3 days a week. You're getting this new culture of Tuesday, Wednesday, Thursday in the office and 4 days, Monday, Friday, work from home, which is devastating if you're, a central business district lunch restaurant. But, with Cogent Communications connecting to these office towers, they still have been growing their core business connecting to these office tower business enterprise clients throughout this entire period. And just to put to rest some of the boogeyman about, we're all going to work from home sort of situation, people were looking at this commercial real estate crisis, this office tower crisis, as being linked to work from home, but it's really not. What had happened was the new generation of office workers, what we're kind of seeing is the obsolescence of the telephone. People don't like chatting on the phone. They want to send emails, they want to send texts, they want to do a Zoom call. But the idea, if you look back at an office movie from the 90s and everybody's in a cubicle, those cubicles were there as sound dividers because everybody was on the telephone all day. And that business culture is dead. The telephone now is obsolete. With the obsolescence of the telephone, the square feet per office employee got cut in half. So what we're seeing in the office world is that square foot per employee is half of what it was, but you still need an agglomeration. You still need people to get in the office to network and to, share ideas and to have exchange. It's the idea that we're all going to be working from home in our bathrobes. That's not going to be effective in any sort of team environment where you need training, you need transfer of skills. There's just some things that still need to be done in person. So I wouldn't put a bear case on Cogent that we're all going to work from home. And I don't think people are, because the last 2 years have kind of showed us that the work from home movement kind of stalled and retrenched a bit.
Yeah.
Online shopping, same thing. It's somewhat stalled and retrenched a bit. So I don't think Cogent's stock price is really suffering from work from home maximalist risk.
Right. And now, are they getting paid based on like volume of data, or, what determines how much money they make from Office Tower A versus Office Tower B, assuming same amount of cubicles, same amount of people? Is it contract based, like monthly or yearly or 10 years, or is it a volume thing, combination of the two?
So, no, so their office business is just on a contract basis, so like number of users. They do not have a bandwidth kind of a metric, which is what they have with their other businesses. Like the internet customers spend more on how much bandwidth they can buy from Cogent, but the office folks are just buying connections. So if you can stuff more number of people, there's going to be a lot more connections that Cogent will take, or a lot more money for that.
In the same way that when you're buying your own internet access as a retail customer, it's, do you want this amount of volume? Do you want that amount of volume? They have their sales team that are interacting with these enterprise customers, and they're trying to figure out, okay, how much bandwidth do you need? How much are you paying for? So it's a very similar process. And in their presentations, they do talk about, it's still, you get these customers one at a time with a sales team, the same way that you have your internet providers knocking on your door, trying to get you to switch your internet provider at home. It is a competitive business. And I think this is where maybe some of the bear case is to see positive results for the company, the sales team has to go out there and get new customers. And the founder and CEO's perspective is, we're cheaper and better. So if we're cheaper and better and we're growing our sales team, we're going to win. And we've done that for the last 20 years. So I think the one leap of faith here is that the product that's cheaper and better and has a growing and skilled sales team that's executed for 20 years is going to execute again and take more market share because they're cheaper and better and they've got a better value proposition at a lower cost.
Right. Well, if they can return to 150 million in free cash flow and they can sell off those data centers for 500 million, pay down debt, I don't even know if they really need to grow that much at this price anyway. Correct me if I'm wrong, but just looking at my numbers, if you buy something for $1 billion and it yields 150 million in free cash flow, you should be all right. I mean, it's not going to hurt, right?
Yeah, and then add on top of that some share buybacks and a return to top line growth. I mean, it's there's a lot of things that can go right when you buy a company for the 1.1 billion market cap.
Yeah. Wow. I knew this was going to be a cool one. Yeah. I like so many things about this. There's a structural competitive advantage that isn't like nebulous. You know, it's pretty hard to replicate core asset base that was sort of acquired in a novel moment. They will never, I mean, I would be shocked if we saw fiber cable be in surplus like that ever again. So there's, you know, it's sort of unrepeatable the way that Cogent acquired its advantages. And then it seems like the execution's been great. And yeah, all the reasons you guys gave for why the stock has sold off all seem like extremely temporary things, particularly the cutting of the dividend. So yeah, you got me really interested. I'm going to think about this. But you guys both own Cogent?
Yes. Yep. I've got Cogent, and I had sold some puts which got triggered with the second stock crash. So now I own a lot of Cogent, but I'm a happy owner of Cogent. I didn't maybe get the best price, but I just want to clarify, I don't think that they've made many mistakes, but the market sentiment is that they've made mistakes. And probably the dividend suspension, I have to infer that the digestion of this acquisition was slower than they had anticipated. If they knew what they were getting into, they would have probably cut the dividend in half 2 years prior. So I do think that the digestion and the growth of their data center business is slower than anticipated. But look at the time we're in right now. All of business has been paralyzed ever since Trump's tariff situation. So I see this through other earnings calls for other companies. They say, look, our customers are there, their projects are there. They're just on pause. They're waiting for clarity on what the business environment's going to be like. They're waiting, are we going to be in recession? Are we not going to be in recession? And I think what you're going to see is 2025 was this massive uncertainty paralysis year. And 2026, everybody just kind of unclenches and proceeds with their long-term plans. So I think the growth and the digestion was slower than they had thought. And the cutting the dividend maybe 2 years late, you could call that a mistake if you wanted to.
Right. That's a pretty forgivable mistake, if you ask me. But cool. I don't want to keep you guys too much longer, but is there anything that we didn't cover about Cogent that you think people sort of ought to know?
Yeah, I didn't fully appreciate originally just how superior their offering was, and especially in a world where, again, this data center build out, everybody's measuring it on how much is spent, but keep in mind that it takes 18 months from the money being spent to the data center actually coming online. So we've, the data center build out ramped up previously, but that doesn't mean that the traffic is already flowing through the network. This is one of those things that is a direct data center build out beneficiary, but only after the facilities have come online. And the data center build out is still increasing. It's not accelerating anymore, but it's still increasing. And then on top of that, just the AI adoption as people figure out. So it takes a certain amount of time for people to figure out how to use AI to drive the traffic. And so all of these are massive, massive reasons why having the network that has the least likelihood of having a cable severed, having the best quality, least interruptible network in a world where so much of this traffic is going to be so much more critical and people willing to pay a premium to have uninterruptible service. I didn't fully appreciate it when I first wrote about it, that they're not a commodity in bandwidth. They have a superior product. And I didn't fully articulate that in my first write-up. I didn't know it until I learned it recently.
And one of the things, if you think about it, when ChatGPT was released, it could barely take a line or two, maybe 3-4 lines of a query. But then those query sizes have been increasing with every new version of LLM that's been coming. And that would mean that as the AI thing grows, the data that's going through these pipes are growing at a pretty exponential rate, which means that's also one of the tailwinds for Cogent at this point. And it's not just new people using connections, but it's also the existing core users are going to be using these bandwidth at an increasingly higher rate.
Gotcha. And then beyond that, you have a lot of images, videos that'll be generated by AI that will have to be stored somewhere. And so I would imagine that might be even a decent use case for those smaller data centers that they're looking to resell that maybe don't have the specs to house Blackwell chips, but they could potentially house SD drives that are storing everyone's AI slop and my aunt's birthday cards that she keeps generating and sending to me. Yeah.
For most of the internet history, a lot of data wasn't saved. A lot of it was deleted. Why would you want to keep all this trash data around anyway? But now that AI can mine this data, there's kind of a new propensity to store all this data much more thoroughly. And so then you're going to have the inference have to go on and retrieve all this data to analyze it. So I think where in the past, the last big driver of traffic growth was, Netflix and streaming video, there's going to be a new driver of traffic growth. And we haven't seen all these new AI use cases be developed yet. It's still early in the revolution. But just to put it in perspective, so we're now 3 years into the AI revolution if you mark it from when ChatGPT launched. And the dot-com bubble, if you start that at 1995 with the IPO of Netscape, if you look at where the internet was in 1998, it was nothing, right? The internet in 1998 was a website on Earthlink called Yoda Ate My Balls. And there was something... I'm not even joking. That's what the internet was. When I applied to university in 1999, it was with a pen and a piece of paper. The internet was not for business. It was not for commerce. The internet was for really poor quality webcomics. When the dot-com bubble burst in 2000, only 5% of households were on broadband and 55% of households had no internet connection at all. And that's after the dot-com bubble burst. There was a survey recently that said 75% of knowledge workers use AI at least once a week, but they're not even using it every day. So the adoption of AI is faster, and the speed at which they're going to discover, what they can do with it. And it's only after that AI gets adopted that the traffic picks up. So this is a situation where you can see AI happening, but Cogent is going to be this inevitable beneficiary of the volumes. And now it's just a matter of sitting back and waiting for the ship to come in, because we can see the ships coming and you can see the ships when they're leaving. And now it's just a matter of when it's going to show up and benefit Cogent.
Right.
This is more like a, did you know, kind of a fact thing. So one of their 7 acquisitions earlier is this company called PSINet. And PSINet was the first commercial internet provider in the world.
Yeah.
Which went bankrupt, and Cogent ended up acquiring them.
Yeah, for a pittance, by the way. I mean, all their first 7 acquisitions, I think, was for a grand total of $60 million. And that those acquisitions for $60 million led to over $1 billion of dividends paid out. Dave Schaefer really was a genius to go in there in the early 2000s and scoop up all this stuff. And he thought he could digest this Sprint acquisition. It appears to have, had a few roadblocks along the way, but there's nothing that indicates that the acquisition was a mistake and they won't reach their targets.
Right. Wow. Might be the first time I've actually been convinced to buy something almost exclusively on somebody else's research, but it is such a compelling case. I'm at the very least going to go back and read some 10Ks and just see if I can't disprove you guys. But at this point, it just seems like it is also going to have to be aware that this is a somewhat timely. I don't know if it'll stay at this price for that much longer based on what you've told me. And when do they report earnings?
Oh, that's a good question. Looks like sometime late February. Sometimes the data sources claim that it's scheduled, but it hasn't officially been scheduled. But yeah, if guidance is correct, that's a return to revenue growth. That could propel the share price. And then also, I don't know if they're going to do individual press releases when they get these letters of intent to become binding on the data center sales. But I think within 2 or 3 quarters, you should see several $100 million of debt paid down. And again, their debt picture isn't even that bad because it's about a third of that $2 billion is their capital leases for their non-owned equipment.
Okay. Got you. Wow. All right. Well, thank you guys for coming on and taking the time to explain all of this to me. So I usually ask people, who else should I have on? And last time I asked AK, who else should I have on? He said, have Unemployed value Degen. so AK, you skip your turn.
Sounds good.
Who else do you think would be interesting to have on the show? Who do you actually like to read, or who do you respect on Substack?
I've become pretty good friends with Ben DeMasi used to be called the ROI channel. Now he's the royalty king. If you're into the royalty space, he's kind of the go-to royalty guy. I've done a lot of collaborations with Colin King at Value Don't Lie. And because we both have a VD in our name, I'm Unemployed Value Degen, he's Value Don't Lie. We created a little thing called Team VD with the burning question.
Yeah.
You're gonna really love it. And the puns for that. But
It's the kind of name that sticks with you.
yeah.
Thanks for listening to the Margin of Sanity podcast. And a big thanks to both our guests for coming on today. Don't forget to check out the links to both AK and Unemployed Value Degen's work in the show notes. Subscribe to them on Substack and drop a comment and let us know if you guys have any thoughts on Cogent. I've got a few more episodes coming before the new year, so be sure to stay tuned and in touch. Thanks for hanging with us, and thanks for listening to the Margin of Sanity podcast. I will talk to you later.